Is this the Mario Draghi moment that they're going to do whatever it takes to really get the economy going? Finally, the Fed is taking our advice. You've never seen the money supply decline going back to the Great Depression. Is there going to be another theater in Asia with Taiwan? Is a very big open question.
Hi, and welcome to Wealthion. I'm James Conner. Well, here we are in October, and it's the last quarter of the year. I can't believe the year is almost over. I don't know where it went, but the last quarter of the year will be an interesting one, to say the least, with lots of economic data coming out. We got Q3 numbers coming out here in the coming weeks. We have 2 more Fed meetings going into the year end, and of course, we have the election. So how do we position ourselves going into year end? To help answer this question, my guest today is Jeremy Schwartz, Global Chief Investment Officer of WisdomTree Asset Management, and WisdomTree has over $100 billion in assets all across different asset classes, including equities, fixed income, and commodities. Jeremy, thank you very much for joining us today. How are things in Philadelphia?
Thanks for having me, James. It's a pleasure to be here with you. Things are, besides for a poor weekend in the sports leagues, things are good here.
I know what you're talking about exactly. I'm a Buffalo Bills fan, so
we can relate.
Anyhow, I want to start with the big picture and get your thoughts on what's happening in the U.S. and China. And I want to start with China, given it's the second largest economy in the world, representing 20% of global GDP. Recently, the People's Bank of China cut interest rates and also implemented a massive stimulus package. The CSI 300 index, the Shanghai index are both up 20% since this news came out. What's your take on these policy changes, and what does it mean for North American investors?
Well, this is definitely a bit of a welcome relief. It's been one of the tougher places to be an investor for the last 3 to 4 years. We've been seeing it in our business. We do a lot of, and even the whole ETF industry has seen flows to emerging markets ex-China. The number one leading emerging market inflow has been a broad ETF that goes ex-China. You've seen countries, India has been a big beneficiary, Japan's been a big beneficiary as people have gone away from China. And a lot of it was self-inflicted. Like, they did their own clamp down on the big tech companies. They were talking about more regulations, and it would look like there was aggressive policy stances to really beat down a lot of these big tech companies. So some of it was self-inflicted, but then they had sort of subdued economic growth. They've been exporting deflation around the world because they've been in a really, you could say, disappointing economy. And it seems like they got towards sort of the maximum amount of pain they were willing to accept, and they're now trying to stimulate. And so they're doing all sorts of measures. And people are saying, like, is this the Mario Draghi moment that they're going to do whatever it takes to really get the economy going? And I think that will remain to be seen how much of an impact on the economy they're doing. They have one of the big overhangs is the housing market, and that's been, and they have a lot more of their wealth in housing. That's been in a very painful slowdown, and people were sort of overexposed there. So now they're trying to get people into equities. That's not a big part of what they do, but the sentiment has turned around pretty dramatically. And you think about what's happening around the world with all the geopolitical tension. China's front and center for a lot of these conversations. And so, yes, there's been a huge short-term pop. There's definitely the trading community is going after it. The question is, will it lead to a meaningful rebound in flows? There's been about, in the U.S. ETF business, $215 billion of flows to broad equities this year. China's in outflows, one of the few places that are in outflows. And, so is this going to get people to turn, their opinion is going to be a big one. You saw a little bit last week, and how long lasting? Is it going to just be this short-term tactical burst, or will it lead to a sustainable growth? Our team is probably a little skeptical on the economic side with whether it really will lead to a major economic growth turnaround. But it's certainly leading to a short-term sentiment rebound at the moment.
Why is your team skeptical?
Well, it's a matter of how much capacity do they have to stimulate. So they're taking measure after measure. They're lowering some of the interest rates. They're trying to lower the mortgages. The question is the capacity to do a major aggressive program. And that's, so our real economist team has not thought it would be overly meaningful on the pure growth side. But that, it's going to take time to tease that out. Short term, the markets move way in anticipation of what happens in the economy. The economy is like the slow moving ship that doesn't turn on a dime. It's not a speedboat. It's a tanker that takes a lot longer to move. But the markets will front run all that, and they're just getting excited that the tone has changed, and that may be enough for some of the market movements to keep going.
So one of the reasons why the markets ripped also was because the People's Bank of China also pledged $113 billion in equity market support. They also said that they're considering a stock market stability fund. And this is very reminiscent to what we saw in the U.S. during the great financial crisis of 08-09. What are your thoughts on these programs? And maybe to your point that you mentioned earlier, do you think this is just short term in nature and it's not going to have any lasting effects?
Yeah, they're definitely trying to get their own local investors to buy. I mean, they had been one of the big sources of demand was the global investing community, and so the question is, that, to me, that's also the big question. But certainly, they're trying to get the local investors more involved. They've got their own pensions that they can put to work. What they call the national team is coming into play, and so the 100 billion sounds like a lot, but for the size of the markets, it's not that much. And so it really will come down to the full global investing communities. What will give them the confidence, And so this geopolitical overhang, people talk about, we see with Russia, Ukraine, you see what's going on in the Middle East. Is there going to be another theater in Asia with Taiwan? Is a very big open question. And that not necessarily a this year event, but people talk about 26, 27 gearing up for that. So there's when I talk about the geopolitical overhang, this is one of the big topics that scares a lot of people about how do you invest in Asia with what they have said about they're going to take Taiwan at some point. And, and what we saw what happened with Russia, where, you were a U.S. investor and you held Russian assets, and we basically made those assets worth zero. It wasn't really helping the U.S. in that case. We were hurting U.S. investors. It actually helped Russia. But so you sort of, what about the U.S. politicians' reaction to these different events? And, that's my worry about some of the long-term, nature in China.
And so you threw out the years 2026, 27 in terms of China invading Taiwan?
Well, that's what they talk about. I don't. It's all speculation, but they say they talk about being prepared to do something by then, and nobody knows what it actually would look like. Do they actually do physical invasions? Is it more of these blockades? Is it in substance? What are they actually going to do? But there was not a lot of these major conflicts for such a long time. We've now had these major regional conflicts with what's going on in Europe and the Middle East, and China's is certainly talks about Taiwan as a big part of the One China policy. And the question is, where is it going to go? These are very open questions that you don't have answers to, but it's definitely a source of long-term risk. And you got to be mindful of what happened just with Russia recently and what you were doing as an investor into Russian securities.
So let's look at the U.S. economy now. It's growing somewhere between 2 to 3%. Unemployment is ticking higher. It's at 4.2% during the last reading. What's your take on the U.S. economy? Do you have any concerns?
Well, we're very happy. Finally, the Fed is taking our advice. I mean, we've been calling out the Fed that they're so slow and deliberate in getting towards what we call, they need to get to a neutral policy stance. And, it seems like on track for being that place by next July. If our senior comes running the Fed, he would do it basically instantly. He thinks they just move so slow and deliberate that, they're basically at their employment mandate when they say their long-term view of unemployment should be 4.2, 4.3%. That's basically exactly where it is. Inflation has come down 80 to 90% of their goal. And if you use some real-time data on housing, you would say inflation is actually well below their target. When we put in, instead of the official BLS number for shelter, we plug in, an average of what's happening in Zillow and apartment list. Instead of a 5% shelter inflation, you get something low ones. That would bring headline inflation to 1.2, core inflation to 1.6. So all of U.S. inflation is being driven by this shelter number. At least the year-over-year changes. There's obviously the cumulative price increases that people are not happy about, but those prices aren't going back down. You got to think about the year-over-year change. And so, our view is the Fed should be at neutral. Neutral, their official dot plot says neutral is below 3. We think that's going to keep coming up, and it'll be closer to 3.5. And that's basically one cut at each of the next few meetings until they get towards, the June meeting. So you have 6 more meetings to get there. And that's largely, again, we think they should get there quicker, but they're on path to do it. They might be able to avoid a recession. You're not zero probability of recession, but they're cutting rates, and we were happy they cut 50 at the first cut.
And I guess one of the reasons why they're moving so slow and deliberate is because they don't want to make another policy error like they did back in 21, 22, and they said inflation was transitory. And then by March of 22, they realized, oh my God, we got a serious problem here.
Well, they should have. We were calling them out at that time too, saying they should have been hiking much faster. That one of the big mistakes is they moved away from looking at the money supply. We've been talking about why did the Fed, all of history, the money supply was viewed as the key driver of inflation. They started looking at the minutia and like monthly changes and say, hey, we see no relationship. But when you have an explosion of money 40% higher, how would that not lead to inflation? So we think they were very overly loose. And, that started declining. You never seen the money supply decline going back to the Great Depression. So that's a sign that they were too restrictive, and again, to why we want them to move quickly. That's starting to grow. Actually, we got more money supply data last week, and it's starting to grow at a 5% annualized rate. The 5% annualized rate is exactly what we want. Now, it's just, it's not 5% over the full year. It's just annualizing the latest monthly change. But you'd like it to be growing at that more healthy level. And bringing down rates is one of the things that will stimulate that.
When you said the money supply exploded by 40%, was that over 1 year or a few years?
It was basically 2 years from the beginning of the pandemic to a few years later. And so it did have this huge pop, and then it continued to grow. But it was 2 to 3 year move that got to that 40%. You had the largest single year change. It was a 26% annual change in the M2 money supply, largest in history, right? So that is what really, led to that big inflationary impulse. People talk about the financial crisis when the Fed was buying all these bonds, and you say, well, is that QE similar? Well, that money didn't get out into the real economy. It stayed at bank balance sheets. This time, it actually did get to the real economy. You had all these government efforts to give cash to people's check accounts, and then the Fed financed it all. So the people say, hey, we should give Powell a Nobel Prize for landing the plane. And we're like, well, he created the problem. You shouldn't give him praise for fixing the problem he created. And so you didn't have to have as much inflation as we had. If they would have been raising rates sooner, interest rates would have been higher, wouldn't have borrowed as much. But they're now, we're happy they're starting to cut rates because we do see that's appropriate at the moment.
Inflation was transitory. There was no need to.
Well, they definitely helped foster what we had.
Now, you also made mention of the fact that the money supply contracted for the first time since the Great Depression.
Yeah, I mean, you really want it usually should grow. There's a simple formula that I learned in school. It was real growth in the economy is real growth plus inflation is approximately equal to the money supply. There's this velocity of money term, but let's just say the velocity of money is constant there. So real growth plus inflation gives you money supply. And so if you want 2 to 3% real growth, 2 to 3% inflation, that gets you 5% money supply growth. When it's contracting, that's a negative sign.
And so what does all this mean in terms of the economy? And we have this ongoing debate whether or not the U.S. is in recession or going into recession. When you look at the money supply flows, what's this telling us?
Well, it's picked off the lows. It's coming back to that 5% annualized rate. So the recent trend is positive. It's still not fully growing at 5%, but it's coming off the lows. So that's definitely a more positive recent trend. And we think lowering of the interest rate from the Fed will help bolster that a little bit more. I think one of the long-term questions for the economy is productivity growth. And, there's all this promise of technology and AI. Like we think inning one of all that benefits starting to diffuse beyond to the Big Mac 7, NVIDIA, and those stocks have been some of the prime, really NVIDIA only has been the prime beneficiary of the spend. And now, so all these other big companies are spending, and the question is what's going to be their return on their spend? And, so I think eventually that will diffuse into the economy, and you'll actually see productivity and profits do well from that. But you're so early in that phase. But that's one of the long-term boosts for economic growth is what's going on in technology.
So when you look at China and the U.S. together, both of which represent 45% of the global economy, so what's happening in these two countries impacts everyone else.
Yeah.
And in the U.S., we have massive fiscal spending still going on. We have this expansionary monetary policy now, both of which are bullish for the economy and also the markets. Now we got these positive changes coming out of China. What does it mean for the rest of the world or the global economy?
Well, China definitely is one of those big consumers for everywhere. So, Europe has been mired in very slow growth, partly, and even sort of the big car company stories that you hear, some of their leading exporters are these big car companies. You hear even in the headline just this morning, it was Volkswagen missing and lowering guidance. And, part of that, my first thought was, oh, well, that's China. And it's that their car companies are now competing. They had become one of the biggest dominant players in China. And now their own companies are competing for some of these big exporters. So, but a stimulus from China that actually does rev up consumption will be helpful for the whole global economy and the big exporters to China. So I think you saw, as that stimulus was coming out, last week was a pretty good week for European markets. We do think it'll benefit Asia, Japan, and some of these other markets. And, if the U.S. avoids the recession because the Fed is actually responding, that's all positive signs. So it's a healthy environment is what you would say.
This show is sponsored by BetterHelp. It's finally happened and was only 4 years in the making. The Fed has cut rates by 50 basis points. Yes, it was a little surprising, but maybe they see bumps in the economic road going forward. And maybe there are bumps in your personal economic road that are weighing on you. Or maybe there are other things that are on your mind, keeping you from thinking about all the good things in your life. It happens to all of us. We walk around with the weight of the world on our shoulders and look at others thinking their lives are perfect with no worries or cares in the world. Everyone has worries and things they think about all the time. You can't let those things get in the way of the fun things you want to do and explore, or the things you're curious about and want to tackle. It's why I speak to someone. It helps to ease some of the negative thoughts and gain a new perspective on some of the things that are floating around in my head. And believe me, there's plenty. If you need to talk to a professional or are thinking about giving therapy a try, give BetterHelp a try. It's easy, online, convenient, and flexible to fit your schedule. Just fill out the questionnaire, get matched to a licensed therapist anytime. Rediscover your curiosity with BetterHelp. Visit betterhelp.com/Wealthion to get 10% off your first month. That's BetterHelp, HELP.com/Wealthion.
So let's discuss the financial markets now, or the equity markets. And the S&P is trading at or near all-time highs. It's like making a new high every other day, in spite of what's happening in the Middle East or over in Asia. Yeah. And I think it's around 5,700, give or take. But what's your take on the S&P going into year end? Do you think the market's going to keep increasing? And do you have any concerns? And what are you suggesting to your clients how they should be positioned going to year end?
Well, we'd say the S&P is around fair value. And what does that mean? So people say, hey, the multiple is high, the markets are high. It's right around 21 times forward earnings, maybe a little bit higher. And we think fair value is 20 times earnings. Now, what does 20 times earnings represent? If you take the inverse of 20 times earnings, it's a 5% earnings yield. 5% as an earnings yield is an estimate of the longer term real return potential. 5% real is below what they did over a long period of time. They got closer to 7% over all the long-term data. But, if you add 2 to 3% inflation on 5% real, you're getting 7.5% of nominal. That doubles your money every 10 years. You compare that to a bond. The 10-year bond today is under 4%. The TIPS bond is 1.6% the last time I was checking. It'll take you 45 years to double your purchasing power in a 1.6% yielding TIP. It's a rule of 72. Another thing we learned in Professor Siegel's class. So 45 years versus, hey, at 5%, you're going to double your money or double your purchase power, your after inflation purchasing power in 14 years. 14 years versus 45 years. It's still a very strong case for stocks versus bonds in the real after inflation sense. Yes, it's not as good as stocks used to do, but it's still way better than the alternatives. Now, you could get outside the U.S., but you look around the world, you're getting 10, 12, 13 P ratios for many of these markets, which is much higher potential forward-looking returns. You don't need as strong earnings growth when you're selling at a 10 times or 12 times multiple. And so, people have only focused on the U.S., partly because of those tech giants and partly because their earnings growth has been so much better than everything else. So it's been warranted. But we definitely believe in that global diversification. We do believe in the broadening rally. Small caps could benefit from the lowering of rates. They're the only ones paying the higher rates from the Fed. So you don't have to be just concentrated in the S&P 500. There are some good opportunities around the world. But still, even if you were just concentrated in the S&P, it's still a compelling case versus bonds.
And what about when you look at the S&P or the NASDAQ? And we always hear people discuss the concentration. It's a few select names that are really moving, one of which is NVIDIA. It's currently trading at 40 times revenues. Are you concerned about these valuations in some of these names like NVIDIA?
Well, the tech sector as a whole, we have a daily dashboard at WisdomTree.com. There's a page called Strategies on the Markets, and you can find all sorts of great dashboards. And one of them is we call it the daily dashboard, and it has 30 pages of charts. One of them is the tech and ex-tech sector. And we put a broader definition of tech. The official tech sector is essentially Apple, Microsoft, NVIDIA, but it doesn't have like an Amazon and a Google, Meta. And so the old way S&P used to define tech would include some of those. If you put them all together, the real tech giants, that's around 40% of the market today. Those stocks are trading closer to 30 times earnings, maybe a little bit less. The non-tech is around 19 times. So, there is definitely that pressure higher from that one basket, but they've been delivering earnings growth. So you can't say they haven't, and the non-tech have not been delivering earnings growth. So they definitely have been warranting of that higher multiple. And it comes down to, 30 times when people say, well, is this like 99 and 2000? Back then, the same type of valuation metric, those tech stocks were well over 60 times earnings. So more than twice as expensive as today. And then you had a lot of these crazy internet stocks at no earnings and just not, some very even little revenue. Today it's different. These are real companies driving earnings growth with the higher multiples. Now, if they have a crack in their earnings, there's no question everybody sees the margins that NVIDIA is getting, and they're all going to try to create their chips that compete. So they're not going to be the only player forever. And so as the question is, how long is their way above market earnings growth last? The spending is not slowing down. Everything you hear, there is a race for more and more spend. And so NVIDIA is definitely the prime beneficiary. But I do think they'll all have their own chips. They're all going to compete. And, it's just a matter of time for that particular stock to have more competition. But the overall tech sector, we think, is warranted of the higher multiple. It's just a matter of when their earnings start slowing down, there's more risk of being a higher multiple.
Yeah, you made mention of the tech bubble of 99, 2000. I just read an article about that recently. And something else that's totally different between then and now is the fact that the number of IPOs that occurred back then. Between 1995 and 2000, there was over 1,500 IPOs, most of which were focused on techs or anything and everything to do with the internet. And now we really don't have those IPOs happening. We see a lot more buybacks.
Well, buybacks have been a way of returning cash versus dividends. You're starting to see, interestingly, some of the big tech companies started paying their first dividends. So now you have Google, Meta, those are big announcements that coming from both of them, that they had been non-payers for a while. They are now starting to return cash to shareholders in the form of dividends, which is a very nice positive, not big yields, but 50 basis point type yields to start. And they often, this goes to one of the drawbacks of most dividend growth investors, is they say you have to have 10 years in a row. I mean, the biggest dividend growth fund, it used to be called Dividend Achievers. They had to grow their dividends every year for 10 years in a row. Well, it's going to be 2035 before Google and Meta will have 10 years of consecutive increases. So that's a challenge of just looking backwards. The Aristocrats from S&P has a 20-year look back. So now we're talking 2045 before these companies will have a 20-year look back. And they're some of the most important, biggest companies in the world. So, we don't think that's the right way to do dividend growth. You got to look forward. We use what we call sort of the Warren Buffett, Charlie Munger quality screens, high profitability, high return on equity, good earnings growth, as seeing who has the most potential to grow dividends, not some historical record of doing 1 year, 5 year, 10 year. It's really more their profitability analysis that says whether or not they'll keep paying.
So you see good value in the S&P trading at 21 times earnings. What about the Russell? I think it's around 12 times earnings. Do you see good value there? And are we going to see a catch up in the small caps versus the big caps?
Well, I definitely wouldn't call S&P like undervalued. We say it's sort of fair value. It's fair value. It's at a reasonable multiple. But the small caps are definitely attractive. Usually those were at a premium to the large caps. Now they're at a discount. And so the question is how much, but it was, if you look at just the last quarter, you had double-digit earnings growth for large caps and double-digit earnings contraction. So the reason why they're 12 times because their earnings were contracting. So, the question is, will they start to turn around? And we do think that the lowering of rates is helpful because some of them, they do pay the variable rates. Large caps extended maturities, like all the U.S. home buyers, they extend their maturities. Nobody's paying it. Not nobody, but very few people are paying we're paying the 78% high mortgage rates. But the small cap companies did have to borrow at the Fed's variable rate. And, so as those rates come down, their profits will improve. And hopefully that supports earnings growth for small caps. The trend is definitely changing where you have decelerating earnings growth from the large tech and accelerating earnings growth from these smaller companies. That should be supportive from a very low base of earning, like a low multiple.
So we have Q3 numbers coming out here in the next couple of weeks. The first one to report is JP Morgan on October the 11th. Do you see any concern with Q3 numbers, especially after Q2? Many companies, Amazon, Airbnb, McDonald's, Starbucks, and many others all came out and lowered their guidance, and they cited the weakening consumer. Any concerns going into when we see these Q3 numbers?
It was definitely, you'd say, a bifurcated, very company idiosyncratic specific story versus something to say one narrative across the entire economy. There was winners and losers. And so you definitely saw the challenges. You saw replacing CEOs at Nike and Starbucks. Those were, two of the big consumer companies and reflected specific issues for them. So I don't know that we're as we talked about at the start, the economy has been holding in fine. So the overall impression is good. And, we do think the small caps will start to perform better. Let's see if this earnings quarter, you start to see some of that.
Yeah, and you raise a good point because we see this real dichotomy going on. You look at the economic numbers and you think, yeah, the economy is doing well, inflation's coming down, unemployment's ticking higher, but it's still below the long-term moving average. And then you hear the commentary out of so many of these companies. And another one that comes to mind was, I think, Delta. They took a $100 million hit just on their Paris flights because nobody was flying to Paris because of the Olympics, right? So they had all this excess capacity. And then you saw the same sort of thing out of Airbnb. And they said people just aren't traveling because they don't have the money.
There's a lot of these. That's a more economy-wide thing if they say they don't have the money to travel. But there was definitely a lot of very specific consumer stories that come in. I mean, what I hear is that the flights are, and I do a decent amount of travel for work. You hear that the flight prices have come down, but the hotel costs have gone up. That hotel demand is very robust, that, it's tough to get a hotel room and that they're charging a lot more for it, but that the capacity was decently supplied. And so you're seeing a little bit of price, getting better prices on flights. But that comes back to each of those particular routes or whatever, in terms of where's the capacity, where there's not.
So let's talk about interest rates. And as you mentioned, we saw a 50 basis point cut here last month. We still have 2 meetings to go, one in November, one in December. What do you think is going to happen?
Well, they're definitely, in our view, he talked about recalibrating rates lower. They're going to keep cutting. And it looks like right now the 25s basically consistently through June. If there's a real weakness, they'll cut faster. Again, we would like them to cut faster even without the weakness, just to prevent it. But it seems like a 25 basis point cut coming. Now, the long bond, interestingly, right after they cut, started trading higher. You got the 10-year got down to the 350s, and then it got started up, pressure to 375, not quite back above 380, but it started trading better. You say, well, what's going on there? Well, if there's less chance of a recession, that should go higher. We actually do think it should trade higher. We think it should be in the 4 to 5% range. And so, you should get a more positive, uninverted yield curve. What we've had for the last few years, people have been surprised we've had an inverted yield curve with no recession. Usually, the inverted yield curve predicts a recession. And there's some particular dynamics of usually the Fed has to crash the economy to lower inflation expectations. People didn't seem to have, as bad as inflation was, the longer term outlook was that, this stuff is going to be quote unquote transitory, it's going to come back down. And so they didn't necessarily have to crash the economy to get that down. And so it's interesting that we've been able to do that with the inverted yield curve, but it should eventually come back to a positive slope. So if the Fed gets down to 3.5, the 10-year should be above 4. I think so we're not chasing bonds. We're not suggesting people rush to the long bond. You're still getting paid to be shorter. And so I think that's one of those things that think about, how do you diversify portfolios? What are the risks today? Well, one of the risks is inflation. So commodities have some value from a long-term portfolio hedging perspective. And sort of short duration bonds have some value from, if the Fed has to stay too high because inflation comes back, that could be other pressure on the other risk market. So it's interesting, what you can do to hedge some of those risks is being short duration bonds and commodities.
So let's talk about commodities, because I want to bring up oil specifically. It's been quite volatile this year. It was stuck in this $70 to $80 range. Now it looks like the new range is 60 to 70. What are your views on oil?
Well, when you come back to the part of the trend for lowering inflation has been oil, and all these commodity prices have come down. I like oil from the portfolio diversification standpoint. Like, not many things can really hedge you from some of those key risks. And whether it's the geopolitical risk, now you can say, with all that's going on in the Middle East today, and oil still hasn't responded to that, which is quite interesting. But now I've got China stimulating. If there is to be a much bigger move, that would be a beneficiary, and that's, say, one of the risks to the global market. So from a portfolio level hedge, I like oil. And, now the short-term supply demand balances, there's all sorts of questions. But I do think that portfolio place is useful to have it.
Yes, and to your point, it is interesting that oil is doing what it's doing, given what's going on in the Middle East and all the geopolitical risks happening throughout the world. But you got to wonder, if we didn't have this war going on in the Middle East, where would the price of oil be? Would it be at $50 a barrel?
These what if scenarios are very hard to say, and you do have that war, and it doesn't seem like it's going any better in the short term. So
I guess my question is, people often say, when you look at oil, when you look at copper, these are barometers for the global economy. Okay, so if oil is coming off the way it's coming off, maybe that's signifying that the global economy is slowing down a lot faster than people think it is.
There's so many specific things in these that it's hard to paint one particular view. That is certainly one interpretation. The supply dynamics are, there's demand and supply. If they have more supply, that offsets some of those issues. That is a mitigating force on that interpretation. But yeah, that's one of those points that got us to wanting the Fed to cut is, hey, don't stay too high for too long. There's all these other signposts saying you don't have the inflationary pressures, and that is one of those things that says you have a little bit of coolness. So yeah, no, I agree with that general take.
And when we look at a few months going into 2025, I can't believe it's only a few months away, but what are your thoughts? How do you think things are looking when we're looking at Q1 or Q2 of 25?
Well, we'll have the election in the U.S., and that, the question will be, what are the economic policies we're getting? Nobody's focused on the debt and deficits. It seems to be both parties are not really focused on the deficit. So again, do you really want to chase the long bond at 375 here? I think that's one of the things, again, saying we think that should be over 4%. If you got a Democratic sweep, the taxes are going up. That's a challenge. So divided. And, if you get the Senate to stay Republican, which it looks like it very well could, then you have less to worry about from a tax perspective. But if taxes are going up in a meaningful way because you get a Democratic sweep, that's probably the most negative event for the markets. But that's one of the things we'll be watching as we go into the end of the year.
Sorry, why do you say it's going to be negative for the markets?
Well, tax rates going up. You're going to have corporate taxes going up, individual taxes going up, but markets don't love higher taxes.
No, nobody likes higher taxes. You should come to Canada if you want to see higher taxes. It's the one thing we do very well.
Yeah.
Jeremy, as we wrap up, if someone would like to learn more about you and get your thoughts on the markets, where can they go?
So WisdomTree.com, I mentioned the dashboards, find our on the market strategies pages, a lot of great material. Professor Siegel does a weekly commentary for us there. I do a podcast with him, Behind the Markets, that if you want to listen to his short take, we have sort of interesting guests every week. That's another place. I'm on X, Twitter, Jeremy D. Schwartz, so you can follow me there, LinkedIn, to reach out for any conversations. And we thank you so much for having me here.
Well, that was a great discussion. I want to thank you very much for spending time with us today.
Thank you.
Well, I hope you enjoyed that discussion with Jeremy and it provided you some insights on what to expect in the coming months. It's going to be an interesting few months as we go into year end. If you're trying to figure out how to prepare for your financial future during these uncertain financial times, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com/free. After providing some basic information, Wealthion will put you in touch with a vetted advisor. There's no obligation to work with any of these advisors. It's a free service that Wealthion offers to all of its viewers. Once again, you can find out more information at wealthion.com/free. I want to thank you for spending time with us today, and I look forward to seeing you again in the future.